Okay, so we're going to start with the fully diluted earnings per share, which is the second half of Chapter 16, and on page 47, exercise 19. All right, on this one, Mills Company has 5 convertible securities outstanding during all of 2013. It has paid the appropriate interest and amortized any related premium or discount using the straight line method and dividend on each security during the year. And then the table is down below, and it goes further to say that the income tax rate is 30%. So, what we need to do is we need to determine the impact. So we'll just take them one at a time. So 9.5% preferred. On this first security, we have 200,000 par value. It was issued at 112, which the issue price for preferred stock is extraneous information, so you can ignore that. Each $100 par preferred stock is convertible into 4.2 shares of common stock. So what you're trying to do in each case is determine the change in the numerator, because if you remember from last Thursday, the numerator for basic earnings per share is net income attributable to common shares of stock. So we took net income and we subtracted preferred dividends for the numerator. All right? So the effect of each of these 5 securities is going to have an effect to the numerator as well as the denominator. And the denominator change is going to be the number of shares of common stock that these convertible securities can be converted into. Okay? So, for preferred stock, the numerator is the $200,000 par value times the 9.5%. The denominator is, if it's $100 par and we have 200,000 in par value in the preferred stock account, how many shares of stock do we have? How many shares of preferred stock do we have? What's 200,000 divided by 100? It's 2,000. And each one of them is convertible into 4.2 shares. That's 19,000 divided by 8,400, or an impact of $2.26. So that's what we're calculating. How much impact on earnings per share do each of these securities in turn have? Go to the next one. We have an 11% bond. On this one, 220,000 face value issued at par. Each $1,000 bond is convertible into 44 shares of common stock. Well, the numerator with bonds is what? It's not a preferred dividend, but how does it affect the numerator from basic earnings per share? What is the numerator? Net income minus preferred dividends, right? So how does it affect net income? How does a bond affect net income? Come on. What does a bond do? Pays interest, right? interest is interest expense. Interest expense affects net income. How? It reduces it, okay? So that's the change, the effect of the numerator. However, net income is after taxes. So when we calculate the interest expense on each of these bonds, we then need to make that interest expense also after taxes by multiplying it by 1 minus the tax rate, which in this case is 30%. So let's do the math. We have 220,000 times 11%. We're then going to multiply that by 1 minus 30%, which is the tax rate. The denominator is 220. They're $1,000 bonds. So each bond is worth $1,000. We have 220,000 of them. So 220 bonds, each convertible into 44 shares of common stock. If you multiply all that out, you get 16,940 divided by 9,680, or an impact of $1.75. Right? Because this is 24,200. So 24,200 times 70% is the $16,940. Is everybody with me so far? Yes? This is just the first step of earnings per share, is calculating the impact. Now we have an 8% preferred. The 8% preferred, 150,000 par value, issued at par. Each $100 par preferred stock is convertible into 3.8 shares of common stock. So this is the same thing, only we have now 150,000 times the 8% divided by 1,500, because each one is $100 par, and they're each worth 3.8. That equals 12,000 divided by 5,700, or an impact of $2.11. A 10% bond. Here's a new twist. We have 100,000 face value, but it was issued at 94. So what does that mean? Issue price on bonds is always a percentage, right? So if we have $100,000 worth of bonds, what did we actually sell them for if the sale price was 94? 94,000, right? 94% of 100,000 face. So we sold it at a discount. So on the day which we sold it, we were selling 10% bonds, and the market obviously wanted more. So they gave us less. All right? So there's a $6,000 discount on bonds payable included in this. How does that affect interest income? Or, I'm sorry, interest expense. Does it drive it up or drive it down? Very good. You had a 50-50 shot. Yes. It drives it up, right? Because that's the reason the discount. The $94,000 is the extra interest that the bondholders are receiving because we didn't pay them what they wanted. We only paid them 10%. So we're going to take the interest calculated on the bond, and then we're going to add the amortization, straight line in this case, the straight line amortization on the discount on bonds payable before we then multiply it by 1 minus the tax rate. All right? So the discount is being amortized over a 20-year life, and each $1,000 bond is convertible into 55 shares. So on this one, we take the 100,000, we multiply it by the 10%, and then we add the 6,000 divided by 20, and then we multiply that whole thing times 1 minus 30%. All of that is going to be divided by the 100 bonds times each bond is convertible into 55 shares of stock. Yes, sir.
Is there a formula for this? I don't use the model here, but is there a formula in the book that kind of you kind of just play it by ear whenever you're working through this to figure out?
You just figure it out. Yeah. Because all you're doing is trying to determine how much interest expense is attributable to this one bond. And then you're making that after taxes. That's all we're doing. And a bond sold at a discount is going to have more interest than it's paying in cash. Because this first formula is just the cash check that it sends annually or semi-annually. It didn't tell us what that was. All right? So that's just cash interest right there. Because the first one was sold at par. So that's all those bondholders are ever going to receive is the $24,200 of cash interest. Okay? So that's all it's doing. All right? So we multiply all this out, and we get 7,210 divided by 5,500, or $1.31. And then the last one, a 9% bond, a $200,000 face value issued at 108. The premium is being amortized over a 25-year life. Each $1,000 bond is convertible into 48 shares of common stock. So we have a 9% bond. And on this one, we're going to start with 200,000 times 9%. And now we're going to subtract the premium, because what we did here is we sold a 9% bond. The market needed less than 9%, so it gave us more. How much more did it give us? It gave us 8% more on $200,000. So dollar-wise, how much extra did they give us? What's 2 times 8? 16. So 16,000. And it's being amortized over the 25-year life of the bond times 1 minus 30%. Each of the 200 bonds, because they're each worth 1,000, is convertible into 48. And that's equal to 12,152 divided by 9,600, or an impact of $1.27. Now this is just the impact of each individual convertible security. What you then need to do is rank them from the highest impact to the lowest impact. So you're ranking them in inverse or in ascending order. All right, so the lowest first. The lowest is this 9% bond. That's the first one. Then we have the 10% bond. Then we have the 11% bond. And then the 8% preferred. And lastly, the 9.5% preferred. And what you would do, and I'll do that here in the very next problem, what you would do with this is you would take your basic earnings per share, the numerator and the denominator, and one at a time, starting with this one, you would add its numerator and its denominator and come up with a new calculation of diluted earnings per share. And then compare that new one to the next one in the list. If the impact is lower than your current calculation of diluted earnings per share, you do the next step. And you do that step after step until the next one, let's say by the time we get done with these first three steps, our diluted earnings per share is now $2.09. At that point, this step 4, the 8% preferred stock, would be anti-dilutive. Because if you add that numerator and denominator to our current calculation, it'll drive earnings per share back up. And that's not what we want to do. We want to conservatively give the market, the readers of our financial statement, the absolute worst case scenario. What would earnings per share have been if everybody who could have converted a convertible security did in fact do so? Okay? That's what we're trying to calculate here. Because what is everybody using this? Let's keep in mind, the most important statistic in a financial statement that investors look at, because of the multiple, the price or earnings multiple. And if that multiple gets too high, the market gets nervous and starts selling off your stock, and then your stock price goes down. So that's what we're trying to do here, is we're trying to provide as much transparency as possible on how volatile the earnings per share could be with all of this. Okay? All right, let's do one where we're actually go through and calculate the effect on the earnings per share. The very next problem, problem number 20 on the same page. Or exercise number 20, I'm sorry, not problem. Exercise number 20. Francis Company has 24,000 shares of common stock outstanding at the beginning of 2013. Francis issued 3,000 additional shares on May 1st and 2,000 additional shares on September 30th. It also has 2 convertible securities outstanding at the end of 2013. They are a convertible preferred stock. Well, I'll get to those here in a second. They earn net income of $72,500, and their income tax rate is 30%. So the first thing you need to do here is what we were doing last Thursday. You need to calculate the weighted average shares outstanding for the common stock. So we have from January to April, we had 24,000 of actual shares outstanding for 4/12 of the year, which is 8,000. And then in May to September, Now we actually have 27,000 shares outstanding, and that's going to be for 5 12s, or 11,250. And then October through December, we end the year with 29,000 for the last 3 months, the last quarter. And that's 7,250. A total of 26,500. All right, basic earnings per share. We're going to take the 72,500 and we're going to subtract from that the preferred dividend. Okay? So the preferred dividend is, we have 2,500 shares of 8.5% $50 par. So 2,500 shares, 8%, $50 par. All of that totals 10,625. 8.5, thank you. All of that still totals 10,625. All right? So that gives us should have written this down. Let's see, 61,875. That should be 72,500 minus 10,625. Divided by the 20. Made that mistake yesterday. Divided by the 26,500. That's a basic earnings per share of $2.11. All right? So, we have a 8.5% preferred. That was a 250,000. Thank you. Because you are correct. 25,000 times the 8.5%. No, I'm sorry. That's the bond. It's 2,500. There are 2,500 times the 8.5% times the $50 par value. And we already calculated that. We know that that's 10,625. Each one of these preferred share stocks are convertible into, there's 2,500 of them, they're convertible into 3 shares of stock. So that's 7,500. Or an impact of $1.42. All right, then we have a 5.5% bonds. So that was 250,000 times 5.5 times 1 minus 30%. Each one of these bonds, there are 250 of them, and they're each convertible into 20 shares of stock. All of that equals 7,625 divided by 5,000, or an impact of $1.93. So this is the first, and this is the second, as far as impact goes. The preferred stock is the lower one of the two numbers. God bless you. All right? So, what we do is we start with the preferred. We add the numerator of 10,625 and the denominator of 7,500. That gives us there it is. 72,500 and 34,000. Divide those two, and we now have $2.13. That's the first step of the diluted earnings per share. Now, what about the bond? Is the bond dilutive or anti-dilutive? We're at $2.13. The bond has an impact of $1.93. You're correct. It's dilutive. It's still lower than where we're at. I'm adding that plus that. Okay? So, you need to include the bond. The numerator from the bonds is 7,625. The denominator is 5,000. Add those two together, you get 82,125 divided by 39,000. And that equals $2.11. And that is the diluted earnings per share. And that's what you would report on the income statement. We're going to do more. Don't panic. Questions? Yes.
Is 9,625 or 7,600?
Where?
On that one.
Over here?
Yes.
This is 7,625.
Is it 80,125 or 82,125?
82.
I got 80.
Oh. Did I write it down wrong? Oh, that's because that's 9. There we go. Thank you. You pointed out the error to begin with. That's 9,625. Not 7. That was my mistake. Okay? Everybody good so far? Yes? Before I move on?
The 10,625 to the 17,500.
This plus this
Yeah, for the bottom.
equals 72,500. That one I'm sure of.
About the second one.
And then plus the 9,625 equals 82,125. I see a furrowed brow or two out there. You want me to go on and do another one? Yes? I'm going to do 2 more like this, but I want to stop and do one different type problem just to introduce you to it because you need to know it. Because there's an intermediary step. So far, we've been dealing with only convertible securities. All right? There is also stock options. The compensatory stock option plans, like we were doing in chapter, I don't know, 13 or 14. Those are always dilutive. So let me do one quick calculation of that, and then I'll go back to this. Okay? Exercise number 21 on the next page, 48. Actually, it's at the bottom of page 47. Mary and Company has 30,000 shares of common stock outstanding during all of 2013. This common stock has been selling at an average market price of $45 per share. They also have outstanding for the entire year compensatory share options to purchase 4,000 shares of common stock at a strike price of $32 per share. The unrecognized compensation cost, net of taxes, related to these shares is $3. And then they earn $36 after income tax, or $36,000 after income tax of 30%. Okay? So, we issued 4,000 stock options that are convertible into common stock. We can reacquire 4,000 times the strike price of $32 plus the $3 worth of unrecognized compensation associated with this compensatory stock plan. And the average price, if we were to go out into the marketplace, take the proceeds here. So 4,000 times 35 is whatever. And then divided by the 45, we can buy back treasury stock of 3,111. All right? So that's the 4,000 times 35 which is what, $140,000? $14,000. No, $140,000 worth of proceeds. Use that $140,000 to go out into the marketplace at the average market price of our stock of $45 throughout the year, and we can buy back 311 shares, 3,111 shares. So of the 4,000 that we issued, we have a net of 889. So our diluted earnings per share is going to be equal to the 36,000 of net income divided by not just the 30,000 common shares outstanding, but 30,889. I subtracted 3,111 treasury shares from the 4,000 stock that we issued under this option plan. So it's that minus that. And that's going to give us a $1.17 diluted earnings per share. Because stock options and stock warrants are always dilutive. They are always going to drive down the price. All right? All right. Let's get back into the convertible shares. Let's do number 24 on page 48. One more exercise, and then we'll do one big comprehensive problem to tie all this together. That is similar to the homework that you're going to be expected to do. Percy Company has 15,000 shares of common outstanding during all of 2013. It has two convertible securities outstanding. They are a convertible preferred stock, 1,000 shares of 9%, $100 par. And then it goes on to tell you how much it was issued for, which we don't care. Each share of preferred stock is convertible into 3.5 shares of common stock. The current dividends have been paid, and to date, no preferred stock has been converted. So, starting with basic earnings per share. That's 54,000 of net income minus the preferred dividend, which the preferred dividend is the $1,000 shares, $100. So 1,000 shares of 9% and $100 par. That's all $9,000. That equals 45,000 divided by the 15,000 shares that were outstanding throughout the year. So basic earnings per share is $3 per share. The impacts. We have preferred, which is the same calculation, the 9,000. And each one of the 1,000 shares of preferred stock is convertible into 3.5. So that equals 9,000 divided by 3,500, or an impact of 257. The bonds, convertible bonds with a face value of 100,000 and an interest rate of 10% were issued at par on July 6th of the current year. Each $1,000 bond is convertible into 35 shares of common stock. To date, no bonds have been converted. So, here's an added twist. It's 10% bonds, 100,000 times 10% times 1 minus the tax rate times 1/2. Why 1/2? Correct. We issued it mid-year. So the only interest that we paid on these bonds was half of the annual interest. And we've got to do the same thing down below because they're 100 bonds, each convertible into 35, but for the weighted average common shares outstanding, these shares could only have been outstanding for 6 of the 12 months. So that's a 3,500 divided by 1,750, or a $2 impact. So this is the one with the largest impact. This is the second one. So back over here to our basic earnings per share. We start with the 10% bonds. We're going to add 3,500 to the numerator, bringing that to 48,500. And we're going to divide that by the 1,750 to bring that to 16,750. And we're now at a $2.90 diluted earnings per share. Do we quit or do we move on? We move on because the impact of the preferred stock is 257. It's lower than where we're at right now. So we need to add the 9% preferred.
So how do you know you move on? I'm sorry.
If the next security in line is lower than we're currently at, it's going to lower the number.
So what we added?
We're at $2.90. The new next one in line is 257. Don't worry about the last problem, the comprehensive problem that I do. We're going to stop before we get to the end. These exercises, every one of them has been dilutive. So we've not had a chance to stop yet. But we will here in the very last problem I do. All right? So we add the numerator of 9,000 and the denominator of 3,500, and we get 57,500 divided by 20,250. And that is $2.84, and that is our reported fully diluted earnings per share. 2250. I added 3,500, which is the preferred denominator, to the 16,750 where I was at the last end of the last calculation. All right? Okay. Problem number 21. Here, this one's fun. And it's on page 59. All right, Weska Company has 5 convertible securities outstanding during all of 2013. Paid the appropriate interest and amortized any related premium and discount using the straight line method. And dividends on each security. And then we've got a table as always. Net income for 2013 totaled $119,460. The weighted average number of common shares outstanding was 40,000. There's no share options or warrants, and the effective corporate income tax rate is 30%. So, basic earnings per share is going to be the 119,000. $460, and then we're going to subtract the 2 preferred. So let me go ahead and write those over here. I'll do the impacts first because that'll make it simpler. All right, so we have a 10.2% bond. Huh? Now I'm going to go ahead and calculate all the bonds, all the impacts over there, and then that way I can just pick the preferred dividends to use for the basic earnings per share. It'll just be simpler. Bear with me. So we have a $200,000 bond issued at par that's paying 10.2%. Each bond, $1,000 bond, is convertible into 28 shares. So we have 200,000 times 10.2% times 1 minus 30%. And each 200 bonds are convertible into 28 shares. So that's 20,400 times 70% over 5,600, or 14,280 divided by 5,600, or an impact of $2.55. We have a 12% bond. The 12% bonds, 160,000 face value, issued at 110. Premium being amortized over 20 years. Each $1,000 bond is convertible into 47 shares. So we have 160,000 times 12%. It was issued at 110. Issued at 110. So how much was the premium? Huh? Yes, it's, the premium's 10%. How much dollar? What's 10% of 160,000? 16,000? And we're going to subtract that. And it's being amortized over 20 years. And we're then going to multiply all of that by 1 minus 30%. All of that is going to give us 12,880. And it is all convertible. There's 160 of them, and they're 47 shares each. So that's 7,520, or an impact of 171. We have a 9% bond. The 9% bond, 200,000 face value, issued at 95, discount being amortized over 10 years. Each $1,000 bond is convertible into 44 shares of common stock. So this one is 200,000 times 9%. We're going to add now 10,000, which is the discount, divided by 10. Right? 200,000 issued at 95 is 190,000. Right? Trust me, it is. So 10,000 was the discount on bonds payable. It's going to be amortized over the 10-year life. Multiplied by 1 minus 30%. That equals, and all of this, there are 200 of these bonds, and they're each convertible into 44 shares of common stock. That's 13,300 divided by 8,800, or an impact of 151. Now we'll finally get to the preferred. 8.3% preferred. $120,000 par value, issued at 108. Once again, the preferred stock, we don't care what the issue price was. Each $100 par preferred stock is convertible into 3.9 shares of common stock. So, what was it? 120? Thank you. 120 and 8.3. So there is 1,200 of these, each convertible into 3.9. So that's 9,960 divided by 4,680, or $2.13. And then the very last one is a 7.5% preferred. This one, 180,000 par value. Each $100 par preferred stock is convertible into 6 shares. So 180,000 times 7.5%. There's 1,800 of these and 6 shares of common stock each. That's 13,500 divided by 10,800. What's that? 2.13.
On that 1.5.
9960 divided by 4680. Yes? No, looks right to me. 2.13? Yeah. Okay. All right, so 13,500 divided by 10,800 is $1.25. So these are the impacts. So which of these has the largest impact? The last one we did at $1.25, that's number one. Then this one, then this one, and then here, and lastly, here. So back to the basic earnings per share. We now know the preferred 8.3% is paying $9,960, and the 7.5 preferred is paying $13,500. That is going to be equal to 96,000. We're going to divide that by the 40,000 shares outstanding, and we get a basic earnings per share of $2.40.
Did you run that back?
Huh?
Did you run that back?
Yes, we started with net income of $119,460. We need to calculate how much of that is attributable to common shareholders. So, we subtract out the preferred dividends. We have the 8.3% preferred paid $9,960, and the 7.5% preferred paid $13,500. Subtract those two numbers, we get 96,000 even. Divide it by 40,000 shares of common, the weighted average common shares outstanding, and we start with a basic earnings per share of $2.40. Now look at our impact list. Right now, you know that we are never getting to that bond. Ever. Because that bond already is higher than where we started at 240. Does that make sense? We're never going to use it. What are we going to start with? We're going to start with the 7.5% preferred. So to the numerator, we're going to add 13,500. And to the denominator, we're going to add 10,800. And we're going to get 109,500 divided by 50,800. Or a preliminary diluted earnings per share of $2.16. The next one in line is the 9% bond. So this one was the 7.5% preferred. So next we go to the 9% bonds. The numerator is 13,300. Giving us a new numerator of 122,800. We're going to divide that by 8,800 is the denominator. Now we're at 59,600 for a new diluted earnings per share of $2.06. What does that tell us? The 8.3 preferred is now off our list forever. We're never going to get to it because we're at $2.06 That one has an impact of 213. However, the next one in our list is the 12% bond. That's the third one in our ranking, and that's at $1.71. We're at 206. We need to include it. 12% bonds. The numerator was 12,880, and the denominator was 7,520. That gives us 135,680 divided by 67,120, or a $2.02 fully diluted earnings per share. And that is the number that we will report on the financial statement. See, doesn't it make sense now? A lot more than when we started. Give me that. I will completely agree. This is without question the most complex chapter in the entire two-semester course. Earnings per share, without a doubt. Especially diluted earnings per share. But it's just systematic. No matter how complex it is, and as always, your homework problem is slightly more difficult than what I've given you here. A little bit more. Okay? So, as always, because it has a combination of convertible securities plus compensatory stock options and things like that. So it's got a little bit of each. But remember, stock options are always dilutive. So, anyway.
Is this homework due on Sunday or do you?
Sunday.